We're going to be talking about decisions that are very relevant to those of you that are starting intern year, student loan decisions, cash flow, disability insurance, and investing basics, as well as fielding your questions. Um, we have uh, um, we have 5 people here in support. Um, one of the people you don't see is Ronnie Colvin. He's a certified financial planner. He is going to be primarily helping with answering questions. If you post them in the chat, and you're welcome to do so. He'll be able to answer some of those questions. And then you have Dr. Jeff Steiner, physician turned financial planner, soon to be a CFP, certified financial planner, who's going to be talking about student loans. And then I'm going to talk a bit about cash flow management, um, the limited money that you have coming in. You got to learn how to use it in a way that helps you to manage life. And then after that, uh, Larry Keller, he's one of the most foremost experts in disability insurance in the physician world. And he's a really good storyteller too. So look forward to his part to help you to see how you can navigate your own disability insurance decisions. And then you'll get to deal with me one more time for talking about investing after that. And I think Jeff may jump in there too to talk as he wishes to. All right. So I'm going to just give it one more minute and then we'll kick it off.
Tyler, are you cool with people throw in the chat where they're from, just like town
Oh
and
yeah,
what they're going into?
that's a great idea. Yeah, if
Like
you
what did you match into?
yeah, I'd love to hear what where you all are coming from and yeah, where what specialty you matched into, um, as well as things you're interested in learning today. Because we can talk about anything. Like we have, concept in mind of topics but you may have specific questions. And also, that's right. This is another note too. After after each of us finishes our part, we're gonna create a breakout room where like so after like each person speaks, then we'll put you in that breakout room. Um, and then any of you who are listening here, you're welcome to go there and you can ask more individualized questions if you wish. So we really want to make this useful for you. Appreciate you taking the time today. Oh, and you know what? And I am rude. Our fifth person is Mandy. Mandy is providing background support and making making sure that that you know tech technically and logistically we're all where we're supposed to be. So really appreciate your help today, Mandy. Okay, now I am yeah. So that breakout room, I'm gonna make that. Okay, so that breakout room is there. No one's in there right now, but you know, after you're done, Jeff, you hop in there, and then anyone that wants
Okay,
to talk to Jeff, you just follow him in there.
perfect.
All right, so Dr. Alavi, pardon me if I'm mispronouncing your name. Currently in Valdosta, Georgia, matched internal medicine, loan consolidation, disability insurance, ventures during residency, like joining an ACOs or value-based organizations for more income. Interesting. Um, Great questions. Thank you for sharing that. And Dr. Patel, Harrisburg, Pennsylvania, OBGYN. Love that. Hershey, Pennsylvania, general surgery. All right, William. Yeah, nice to have you here. Dr. Bierman, general surgery. Lovely. Yeah.
Mhm.
Let's see. family medicine, occup occupation insurance. Yeah, the own occupation insurance versus disability insurance and opening a Roth IRA. Yeah, we can definitely talk about all those things, Dr. Tran. Um, Loan repayment options. Yep, we're gonna jump right into loans. That'll be our first topic. So, yeah, for private loans, it is a unique subset of decisions. Budgeting,
Yeah.
investing. Oh yeah. Okay.
And Tyler, I'll probably have you hop in on the private loan discussion since you probably have more experience with that than I do.
Sure. Yeah, happy to jump in. Yeah. All right. Well, let's get started. I'm Tyler Olson, financial planner, and love having opportunities like this to share financial education with those of you in training. It's super important. Really, quality of life improving. I believe that 100%, and I've seen it myself. So it's good that you're investing in this. We're going to be talking about student loans. We're going to be talking about cash flow, disability insurance, and investing, as well as your specific questions. So to get us started, Jeff Steiner, Dr. Steiner, and financial planner now. He's going to be talking about student loans, and take it away, Jeff.
Hi, my name is Jeff Steiner. I am a former pediatric anesthesiologist, now turned financial planner. We are going to cover student loans. So this is kind of like navigating the dumpster fire for new grads. I'm a PGY 21. If you happen to see this lecture live, we re-recorded it to make it to kind of adjust a few things, changes in the student loan landscape. Hope you'll enjoy it. From a professional disclosure, I am the founder and investment advisor representative of Second Opinion Financial. This is for informational and educational purposes only. I'm not giving specific investment advice. Now, what I tell a lot of residents is, what I tell them, what I tell a lot of residents is, or are, what is the English on that? What I tell a lot of residents, you just have to tread water. You don't have to fix everything in residency. You don't have to be perfect. This is about you, like, just kind of, you're someone in survival mode for finances. That includes student loans. You need to make part of your goal, or I would suggest that you make part of your goal, just tread water. You don't have to pay them all off. You don't have to do it perfectly. All you got to do is like get through residency with your mental health intact and move forward. And part of residency is building habits. Some of those habits you're going to build as you learn your craft as a physician, and other habits you're going to build like in finances. And the way that I think about finances for physicians is it's really about like a financial puzzle. Physicians, by and large, don't have financial problems. They just have financial puzzles. And trying to put it all together can sometimes be a challenge, but it can be done. And what I'd like you to do is move from being unintentional to being intentional. And so, like, you may have checking accounts or bank accounts or credit cards that you've just kind of collected over the years, and maybe you just need to get organized, right? Like, and be more intentional about how you're managing like your finances and specifically how you're managing your student loans. Because for a lot of people going through medical school, you just kind of sign the thing and move forward and worrying about getting residency. Like this is a time to get intentional about your finances, including your student loans. Now, I tell physicians this all the time, a lot of my clients, like, you don't have to change everything, just make small changes to move forward. And so I tell them, like, it's a sodium correction. You don't have to fix everything all at once. So let's get into student loans. It's a dumpster fire and it's absolute chaos. I mean, if you feel a little overwhelmed, it's normal because the system and how it's set up is confusing and it's not straightforward. So let's get in the student loan landscape. So the SAVE plan that you might have heard about while you're in training is ending. We're expecting full termination of it in July of 2028. Um, there are income driven repayment plans available for graduating residents or graduating med students, old IBR, new IBR, and pay as you earn or payee. Some people pronounce it. But let's take a step back. There are some repayment plans, and this is what you'll probably be defaulted into is a fixed repayment plan. Now, there's a standard fixed repayment plan where you make fixed payments on your loans based as if you would pay them off in 10 years. For most residents that have uh, like a large number of student loans, that's unsustainable. You cannot make those payments. So then some people are like, well, maybe I'll do the graduated. The graduated plan starts off with lower payments, but then every 2 years it adjusts so that as you go through, it still gets paid off in 10 years. And then the last one is the extended and go up to 25 years, either fixed or graduated payments. Um, but for most residents, it makes sense for them to get in an income driven repayment plan or an IDR. Now, currently, like as of today, there are 5 different income driven repayment plans. Save, we know, is going away. Pay as you earn, we know will eventually go away. And we know for residents, ICR is not a good choice. So that kind of leaves you with old IBR and new IBR. Now, in July of 2026, we should be having a repayment assistance plan come out. And I'll kind of compare IBR and the repayment assistance plan. And for some of you, you may be thinking like, okay, I'm planning to do PSLF. I don't know if it's like works, right? Like you've heard stories of it not working for some people. Well, those were early on in the system or when this like public service loan forgiveness was first introduced. And not a lot of people qualified because they didn't have enough payments. They didn't have the right type of payments. They didn't do the application. They didn't do the paperwork. I'm here to tell you a lot of physicians do get student loan forgiveness through PSLF, and it is a non-taxable event, which means they don't have to pay taxes on that forgiveness, which is fantastic. So to qualify for PSLF, you must have direct loans. So or like federal direct loans or a consolidated loan, and we'll get into that. You have to work full time for a not for profit, a 501(c). Your repayment on your loans has to be in an income driven repayment plan. And then you make 120 payments and then apply for PSLF and the balance is forgiven. Now, the 120 payments do not have to be contiguous. For many residents, it makes sense to default and plan as if you're going to do PSLF. And you're like, well, but I want to go into private practice. And I can't tell you how many internal medicine residents I've met who said, I'm going to do my 3 years of residency. I'm going to get out and practice as a hospitalist, go make bank. Talk to them in a few years and they're applying for fellowship, right? So they just added another 3 years, which is fine. And they want to do like they train for the thing that they really want to do, which is a fellowship, like requires fellowship. So now they're 6 years in, right? And 120 payments, if you do the math, is like 10 years of making just one payment a month. You can't like double up payments, right? So they're already 6 years in to a 10-year like program. And if they do a fellowship, they might end up working at a not for profit, which then would qualify them to make still income driven repayment plans while they're attending. Now, some people are like, well, should I just wait for the RAP plan? Because I heard that's a great plan. So why don't we just do an example? And this example is going to be for like a surgeon, right? So let's do that. So we're going to compare a fictitious resident, med student, just graduated, with 250,000 in student loans. Let's say it's at 7%. Okay. One decides to get on the income-based repayment plan. The other decides to get on the RAP or the repayment assistance plan. So the IBR, the interest is subsidized for the first 3 years that you're in the plan. The interest subsidy for the RAP is forever. What does that mean? It means if you make a payment under this income driven repayment plan and you do not cover enough interest, the government's supposed to pick up the interest. Now, RAP has not launched yet. This is what they say is going to happen. I'd like to kind of see what happens when it actually does. Now, IBR, there's no principal subsidy. And on RAP plan, there's a $50 a month principal subsidy. Now, that's fantastic, right? Like, not only if your payment is low and doesn't cover the interest, you also get $50 like kind of from the government to help pay down the loan, the principal side. Now, the big difference between these two plans is the 10-year standard plan. I'm sorry, the IBR has a payment cap at a 10-year standard rate, which means the payment under IBR will not go above the 10-year like standard repayment. In the RAP, there is no payment cap. And the way that they like calculate these payments are very different. IBR works on family size and a discretionary income calculation, which uses the poverty level. The RAP plan is somewhat simplified and it's a percentage based on your income. Both of these are based on your adjusted gross income. So let's just compare the two head to head. Let's say you graduate, you do not consolidate. We'll talk about that in a little bit. You then start paying on your loans partway through your intern year. So if you were to file, let's say you're single, that's the other caveat. You filed your taxes. If you haven't filed your taxes, go ahead and file them so that your AGI for most medical students who aren't working is going to like be very low or zero. And so that equates to like a $0 payment. For IBR versus RAP, the first like round of income certification, you'll be paying $0 a month for IBR. For RAP, there is a $10 minimum. So no matter what, no matter how low your income is, it's still $10 a month, still very doable as a resident. So now let's say you file your taxes after like for your 2026 taxes. Now, you will have only had half a year's salary as an intern. So that means when you file, like, do your income recertification for the loans, you'll only have like half a year's salary. So then your first payment out of like based on your salary now is somewhere around $62 a month for IBR. For the RAP, it's going to be somewhere around $88 a month. Okay, a little bit better for RAP. So then let's transition. We go for another year. Now you're at full like resident salary, IBR somewhere around $384 a month. The 70,000 at RAP is going to be 408 a month. Now it's like, now it starts to get a little pricier for RAP compared to IBR. So let's say that your first year is in attending as a surgeon. As your salary is ramping up, half of it is like resident salary and half of it now is attending salary. Under IBR, it's at $1,884 a month. And then under the RAP, because there's no cap, now you're at $2,083 a month. So what happens, or actually the IBR is going to calculate out, you haven't hit the cap yet. Where you hit the cap is when you hit 500,000, the payment would go over that, but it's capped out at $2,900. And if you see under the RAP plan, it's now $4,000 a month. So where the RAP plan really hurts residents is not so much during residency, it's when they're making attending pay. And for most residents, most physicians, your training will not last 10 years. For some of you, it will. I get it. They're kind of the outliers. Most residents will have a residency 3 to 5 years, right? Maybe a fellowship 1 to 3 years, maybe a couple fellowships. But at the end, when you're making the like final income driven repayment plan payments as an attending, it could be get very expensive very quickly. So let's talk about like the complexities. Like the simplest thing, and this is for like new residents, like if it's just you and your student loans, you'll probably be able to figure this out on your own. Where it gets a little complicated is when you have a significant other that you are filing taxes with. So you're married. And then how you file your taxes kind of depends on how you'll make your payments on your student loans. So it can affect it. And so if it's just two of you and one of you has student loans, then you might be able to kind of figure it out on your own. Where it gets really complicated is where you have two spouses, both have student loans. This is where you may want to get help. And you may even want to get help like filing your taxes if you're married, filing your taxes, because how you do it could affect your student loan like repayment. And if you're trying to go for PSLF, the goal is to give like the least amount of payments during the time to get the most forgiveness. Okay. So filing your taxes. If you're single, you're just going to file it single. If you're married, you have two choices: married filing jointly and married filing separately. Sorry, married filing separately. So what does that look like? Let's say we have a resident with a spouse at home. Okay. So they do married filing jointly. And their student loan payment, let's say the resident's earning 70 grand a year, their significant other staying home. The student loan payment would be like $313 a month under IBR, and under the RAP, it would be $358 a month, right? So now let's say that you actually live in a community property state where you're able to take your income and legally split it between the two of you. And that's what you have to do in a community property state. You split it. So now instead of 70 grand, now you like give 35 grand to your significant other. And then now you're reducing your student loan payments like pretty much in half. Okay. Now let's talk about a case study. We've got a married medical student. Their significant other earns $140,000 a year. They file married filing jointly. The new IBR plan, they're going to be about $896 a month. If they were to have filed married filing separately in a non-community property state, their new IBR would have been $0 a month because they have zero income. If they're in a community property state, then the new IBR would be $313 a month. Now, you have to, like, if you're married and you're trying to figure out married filing separately, married filing jointly, like, this is where it gets pretty complex. And I would recommend that you work with a tax filer who knows what they're doing for student loans specifically, because when you do married filing separately, it changes your deductions and credits. You get no student loan interest deduction that you pay, no child care tax credit. You cannot do a direct Roth IRA, and you really need a CPA or an enrolled agent who understands how to do married filing separately in a community property state. Now, what if you're like, holy smokes, I thought I was just dealing with student loans, now I'm dealing with taxes, right? Like we filed married filing jointly, like we filed an extension, how are we supposed to file taxes? And then you've got the one person who's like, hey, we have to pay back our loans. Like they're totally in another, like they're out to left field. So let's bring it home. What if you were married and you filed your taxes, married filing jointly for 2025? You cannot amend your return from a married filing jointly to amend to a married filing separately. You're like the you've cast the die. Okay. What you can do as a resident, you can like use your alternative documentation of income. So when you graduate and the payments are about ready to start, you say, hey, I'm not going to use my tax return. What I will use is my ADOI, so alternative documentation of income. You're going to use your pay stubs. They'll calculate your first payments. And then when the next year comes around, consider like talking with someone about married filing separately to see if you're able to get the payments like decreased. And I get this question all the time. If I did married filing jointly this year, can I do married filing separately this next year? Like, absolutely. It's just you've got to, if you do married filing jointly, you cannot amend that year's return to married filing separately. So there are kind of two different ways to do income certification for student loans. One is through the IRS tax information, and then the other one is the alternative documentation of income. So what can you do now? File your 2025 taxes, even if you're not required to do so. Now, by the time you see this recording, we've already passed the tax date. But if you can file late and you don't owe anything, I would go ahead and get your taxes in. Talk with a CPA if you have not filed your taxes about filing your taxes and if you can still do so now. Stay in touch with your student aid office through graduation. Plan on your student loan exit counseling. Prep your student loan like communication system. So make sure your servicer has a good email address. Log into your studentaid.gov. Now, here's the thing. In the past, the recommendation for all med students graduating was to consolidate their loans. We had a question come up during the live webinar, and I did a deep dive on it. And this is what we've kind of come to or kind of realized. If you consolidate your loans, you may lose access to the IVR plan. And the only plan that's available to you is the RAP. And remember, we want to try and stay in the IVR plan because it will help you like years down the road when you're making payments as an attending. So, like, how does that even work? Well, we're bumping up against two rules that go into effect July 1st of 2026. One is IVR is only available for loans disbursed before July 1st, 2026, and loans, including consolidated loans disbursed on or after July 1st, 2026, are not eligible for IVR. So the chances of you being able to graduate and get your loans consolidated in time is very slim. A lot of people are moving out of the SAFE plan. Like everyone's graduating right now. The loan servicers are inundated with work. It is, in the past, we told people to consolidate so we could get more $0 payments. I think for this class, it makes sense for you not to consolidate. And because you lose out, you could very well lose out on the IVR plan. Now, even though your loans were old loans, it's still considered a new loan if it's disbursed on or after July 1st, technically. And I don't want you to consolidate your loans and then miss out on IVR. So what does a checklist timeline look like? File your taxes, download your NSLVS file. So that's your like My Student Aid file. And make sure your email addresses are up to speed on the different places. Student aid and your loan servicer. Do your loan exit meeting. Graduate. Enjoy your time. When you're graduated, make sure the contact information is updated. Okay, make sure they have all the right info for you. Start your internship in July. Somewhere around November, your grace period is going to end. When it ends, go ahead and consider applying for income based repayment. There's some people who may want to apply for pay as you earn. I don't know if it brings as much benefit to people by doing that, but that may be something individually you'll just have to look at. Go ahead and put in your application for public service loan forgiveness, and then pay attention to when the income certification date hits. Now, if you start your loans in November, it's they'll probably tell you it's going to be like summertime, but you want to pay attention to that. And if by chance you did marry filing jointly and you've got a higher payment because you had to do the alternative documentation of income, go ahead and like file your taxes. If you're going to do married filing separately, do it early in the year and you can recertify your income early and tell them that you've had a reduction in your income, which you have by proof of the tax return. So there are things that you can do today, things to like in the future, and then things to keep on top of. What can you do today? Take a moment, download your student loan file. This is your NSLDS file. Log into student aid, you got gov, go to my aid, download my aid data, and then it's going to be mystudentdata.txt. Keep that in a safe place. Make sure your emails are current. Keep copies of everything related to your loans. And then you may decide between like PSLF and paying off your loans, depending on how many loans you have. It is an asymmetrical risk to going for PSLF versus trying to pay off your loans early to save interest. It really depends on how big of like loan burden you have. So that's just something to think about. Things to do soon. When the grace period ends, apply for PSLF, submit your employer certification form from residency, and calculate your payment in the new IBR and see what it looks like. And take a look at the REP. I really feel like for attendings, it's going to be so much more expensive. And then things to do in the future. Remember your income recertification date. If you don't recertify, you'll be changed to a 10-year repayment plan. And if you're an IBR, the interest capitalizes, which means they take the interest that was accumulating on your principal, the amount that you borrowed, and they'll add it to there. And now you just compounded your student loans. So you don't want to do that. Turn in your employment certification form and at least download your NSLDS file at least annually and save all documentation. If you want to get a hold of me, here's my email. Thank you for having me. Congratulations on the match. And so exciting to be starting intern year. Just tread water. You don't have to fix everything right now. And you've got this. Does that make sense for everyone? Because I kind of wanted people to understand. Okay, so how does married filing separately change deductions? Tyler, do you want to answer this one since you're the
Sure.
enrolled agent?
Uh, so when you file your taxes, married filing separately, you fall under a different standard deduction than if you file jointly. Now, if you obviously like if you're married filing separately, your spouse also gets that standard deduction, but it's essentially the same deduction but cut in half. So the reason why it can have an impact is it depends on who's earning the income. Now, if you're in a household where you're like in 2025, for example, let's say you made no money, but your spouse did, and you file your taxes filing separately, your spouse, if they made like say 60 or $70,000. Under the standard deduction, that 60 or 70,000 would be added in with your income, which was zero. And then you get the entire standard deduction for married filing jointly is like 30 some $1,000s. But if you married filing separately, now your spouse with the income only gets 15,000. And so their effective tax rate or the total tax due on that portion of income would be higher if you file your taxes separately. But it might be diminished enough that it still makes sense to file separately because you're talking about the difference between a $0 student loan payment and a $400 monthly payment. Like, let's say that the tax liability difference is like $1,200, but your student loan payment is zero instead of 400. You can extrapolate that over the course of a year. You're looking at it like of a value difference of $4,800 versus 1,200. And so then it's worth it to file separately because you are paying $1,200 more in taxes, but you're paying $4,800 less toward your loans. There's a further nuance to this. Cash flow survival is one aspect, and the second is if you're not going for public service loan forgiveness in the end, then you're not really saving this $4,800 or the net of $3,600. You're just deferring it or pushing it off to later. Whereas if you know that you're going for public service loan forgiveness, if that's your career trajectory, then you can more reasonably say, like, this is a net benefit for me long term, and it's helping me with cash flow management while I'm living on a limited income. However, if you are not going for public service loan forgiveness, that doesn't necessarily make this a bad decision because the cash flow management piece itself can be important enough to file separately. Just because survival, financially speaking, in training, you need to be able to tread water, and a net $300 more per month for the first 12 months that you're out of school may make a big difference in your quality of life and ability to manage things. And $3,600 less, or sorry, let me back that up. $3,600 more to be paid in student loans 8 years from now. It sounds like, oh, well, that sounds irresponsible that I'm pushing off. I should be making these higher payments now. This is a blip in the grand scheme of things, in like the long-term picture. But in the short term, an extra $400 payment that
Right.
doesn't have to be there, that can be life-changing.
Right. And that's kind of why we tell residents like tread water and get into an income driven repayment plan. Even if you plan on paying it off early. Like I've known some residents who are like, well, I think they have smaller loans, they have a spouse. They're like, well, I'm thinking I'm gonna pay it off early. But you don't necessarily know. And especially if you're like a high cost of living area, like get in an income driven repayment plan just so that you can make your payments. Cause back in the day, so this is like 20 years ago, they used to tell residents to defer and go into forbearance. And now with the income driven repayment plan options, that just doesn't make as much sense. And if you don't know for sure what you're going to do, default in the public service loan forgiveness area or go that route because it's an asymmetrical risk. And that is this. If you end up paying off your loans and public service loan forgiveness isn't in the cards for you, you'll end up paying more interest over the time of the loan. However, if you go for public service loan forgiveness, then the forgiveness of those loans is so much larger than the risk of you not being able to do it. Because I met plenty of residents who were internal medicine. Oh, I'm going to get out and be a hospitalist. PGY 2 year, we're talking again, and they're like, I'm going to do cardiology. PGY 6 year, we're talking, and again, it's like, well, I'm going to do a fellowship in interventional. Like before they know it, they're like 7 or 8 years into paying toward your 120 payments. and they haven't even hit like attending world yet. So um, tread water. You don't have to, again, sodium correction. You don't have to do everything at the same time. Just take your time.
I love hearing the doctors speak come through. I'm like, I don't know what he's talking about, but I'm sure they do.
um, do you want me to head into a
Yeah, go
room?
go ahead. Yeah, go ahead and pop in the breakout room. Or you know what? Wait a second.
All right.
I'll talk about the private loans and
Okay.
then you head in there. Um,
Okay.
so if you have private loans, and I think actually someone specifically asked about this. Um, let me make sure I've got that. Uh,
Yeah. No. Ronnie says sodium correction, like having Doritos with your lunch in the cafeteria. Um, Sodium correction, when you are fixing a patient's sodium, like it's too high or too low, you need to be methodical and slow with it. If you do it too fast, you can cause irreversible like brain damage. And so for my physician clients, I just, whenever they're getting like too caught up and trying to do everything, I'm like, whoa, just like, let's just do a sodium correction. Let's take our time. We don't have to bolus it. We're fine. We're good.
Good to know. Thanks, Jeff. All right, so someone did ask for advice on loan repayment options if used private loans. Okay. So private student loans are they're they're a very different category from federal loans because they don't have the nuance of income-based planning or public service loan forgiveness. They there are some states that offer student loan forgiveness programs. Um, Several states do that they don't care if the loans are federal or private. So if you know where you're going to land after training, and particularly if you're in primary care, and especially if you're going to be in a rural area, I would check out the state in which you're going to be to see if they offer any student loan forgiveness programs because that it may not be everything, but I think I've seen it anywhere from like 25 to $200,000 cumulatively in forgiveness that some of these state programs offer. Um, and um, so you'll want to take note of that, and then obviously outside of that, if there's no forgiveness, then you just have to treat it like any other debt that needs to get paid off. But like in line with what Jeff was saying a few minutes ago, there is not a lot of there's not a lot of income to be paying off a significant amount of debt. So like my first thought is to contact Laurel Road. They've got a pretty smooth process. They have a pretty good understanding of the physician space. They are a large company. Not too long in the past were purchased or bought out by Key Bank. So they're a pretty big deal in terms of like exposure and infrastructure, but their products still seem to be pretty well designed for doctors. If you need to refinance with them, they do have a $100 per month for up to 7 years in training. It's Laurel Road, Laurel Road. Thanks, Ronnie. So the that's a good option. There are other companies out there that offer refinancing. Not, the benefits are just to try to put it to the side for now. Get it to a manageable payment. Because like it's not about getting the lowest interest rate, although sure, you want to try to get the lowest interest rate that's available to you, but you don't want to choose a term that is not manageable. I would venture to say like I've seen some loan repayment options where the interest rate is lower, um, the interest rate is lower on some terms, but the payment amount ends up being like $1,000 or $1,500 per month. And maybe some might think that they could eke that out, depending on how slim the rest of your budget is. But goodness, that is a huge portion of your salary. And to commit to that, like once you commit to a private loan like that, that's it. If you don't make the payments, then you start having some severe impact on your credit score. And you want to buy a home in the future, you can't have missed payments on loans. So, now to your question, if my payment is in a deferred plan until after residency, should I still consider refinancing? If it Probably not, because like effectively refinancing to one of these programs, it's like $100 a month. It is a deferral. It's just like a small monthly payment that they want out of you. Um, I think that the decision of refinancing to something like a Laurel Road would depend on it would
Mhm.
depend on the interest rate differential, to be honest. If your current private loans are like, oh, you're in deferment for 5 years. If training is going to last 6 years, then that's not going to work. So you got to check the terms to see like how long the deferment goes. I've met with many fellows who suddenly all of a sudden they get contacted by their private lender and they're like, you're gonna have to start making $2,200 per month payments. And they're like, I only make $70,000 a year. And you don't want to get in that situation if you can avoid it. So find out what the term is for the deferment in your plan and see if it's long enough. The second thing you want to look at is the interest rate comparison. If you checked out rates with Laurel Road and the rate was going to be like 7%, but your current lender is 10%. Then you have to weigh the pros and cons of a higher interest rate where you're not paying anything for, I'm just saying 5 years. I don't know what it is exactly. Um, or, switching to a lower interest rate, a meaningfully different rate, but having to pay $100 per month. And if that is, sometime, depending on the situation, that $100 can make a big difference. But sometimes it doesn't. Sometimes you're like, yeah, that I can manage that. And the interest expense is lower, which is long term very helpful. 3% difference. Yeah, let's run a quick calculation on here. If you've got let's say $225,000 in student loans, and you could save 3% interest, 3% in interest, that's about $6,700 per year that you would not be further accumulating in debt that has to be paid off later. And then over the course of 5 years, it's $33,000. It starts to add up. But the terms need to make sense for your financial situation.
Like a quick view on Kentucky, like they do offer a state loan repayment program, offers up to 80 grand for a 2 year full-time commitment in a designated rural slash underserved health professional shortage area. Now, a lot of times when people see that underserved, they automatically think it's like in the middle of nowhere or up in the Appalachia Mountains or something, right? And sometimes that can be a large um, county hospital in a big town. So before you just write it off as like, oh, this, I don't count for this, you may. So that's something you may want to take a look at too.
Yeah, thanks for pulling that up, Jeff.
Yeah.
Okay, so what we're gonna do now is we're gonna take a, let's see, we're gonna take a couple of minutes and Jeff, why don't you pop into the breakout room there?
Okay.
And I set it so that any of you can go over there freely to talk to Jeff. I'm not going to start my part on cash flow for a few minutes. Um, Jeff, I'll send you a text when I'm about to start so that
Okay. So I
because
can
it
let people know. Perfect.
yeah. So like if you have questions for Jeff, but you're not going to miss the main next part. So if you have questions you want to ask Jeff about student loans or anything at all, you can pop in the break room and then we'll start up the cash flow topic in a few minutes. going to be starting up in about 1 minute. All right, everyone. So I let Jeff know that I was going to get started up here talking about cash flow, and um, anyway, he's still chatting with a few people, I think, and they can filter back in as they wish to. Before I jump into talking about cash flow, I did want to address one remaining loan repayment question that I missed. Somebody asked about loan repayment advice for people not pursuing academia post residency. So, what we're talking about here essentially is you're going to pay off your loans after training. And that's a very doable and viable path. If you know that this is your track, then you could you could take two approaches. One, you can decide I'm going to keep my options open. I'm going to stay in the federal loan program just because they provide income-based planning, income-based payment plans, which provides a measure of protection. You can much more readily go into deferment on federal loans, and the so that's the benefit, even though you're not going for public service loan forgiveness or anything. Um, of course, the drawback is that you might, depending on interest rate comparisons, you might be paying a higher interest rate on your federal loans than you would be if you refinanced, but the difference might not be that big. Um, Nevertheless, for some, keeping that optionality there is important, and just basically getting on to the lowest cost income-based plan while you're in training. And then once you're done with training, then redirect your attention to a combination of saving up cash, paying off your debt, investing, and living a measurably increased cost of living life, all to get all at once. The other choice is you could consider refinancing to a private lender if it's truly appealing to you that you could get a lower interest rate so that the interest expense that's accruing over the next several years is not as high. And you get on a Laurel Road program where it's only $100 a month, so you can manage the cash flow of it. No problem. Then that can be viable as long as you're okay knowing that you are giving up public service loan forgiveness, income-driven repayment plan optionality, and the deferment options or forbearance options of federal loans. Once you're in a private on the private side, that's it. You cannot go back. So it's important to make that decision with both eyes open. In either event, the steps are fair. They look fairly similar from a cash flow standpoint. Low payments as possible while in training, aggressive payoff once you're out. All right. Okay, so we are going to begin cash flow. All right. I am not a PowerPoint slides person, so you're not going to see any of that from me. You just get to look at my face. Um, Basically, what I want to talk to you all about is how to carefully manage your savings, whatever that is that you've got now, and your upcoming income. So some are coming from a place where they have some family support. Maybe they had a little bit of savings from a previous job. Maybe um, Maybe you have a spouse that works, and so you've got some cash on hand to help you bridge the gap between medical school and your first intern year check. There's a lot of doctors, though, that do not have any of that, and they are burning through cash these months. April, May, June. You go to orientation, second or third week of June. Maybe you'll get a paycheck for that at the beginning of July. A lot. I'd say most residents get their first paycheck around the middle of July. So you've got two subsets or two bubbles that you're in. The first bubble is surviving between now and the first paycheck. The second is after you start getting regular paychecks. The way in which you need to address the now is to identify what expenses are coming up that you know you're going to have to pay for, and then list them and total those expenses. And I don't just mean deposit on the rent on the apartment or closing costs on your house if you're buying a house for intern year. Um, I even mean just like living expenses, food, groceries, gasoline, whatever. Everything that is going to go out of your checking account that's going to get charged to a credit card, try to identify how much money that is in total between now and when you're going to get your first paycheck. That's another thing you want to find out. If you haven't already found out, speak with the speak with the senior residents in your program and find out, hey, when do we get paid? That's a totally normal question to ask. There's nothing disrespectful or embarrassing about asking about when you're going to get paid because you're moving potentially across the country to a new place. You got to know these details. And then once you find out, now you've got this time frame in mind, you know how much cash you need to be able to have. Now, some of it, or maybe all of it, is going to come from savings. Some are in a position where they have some savings and they're going to have to finance the remainder. Now, if you're going to have to do that, if you're going to have to finance the remainder, then some have found success with getting a 0% interest, like an introductory 0% interest credit card. Obviously, for things like first month's deposit for your apartment, a lot of times you cannot get you can't pay that with a credit card. I mean, I know there is like some companies like I think it's Built that has some systems in place for that, but by and large, you're going to have cash for that. So you also need to identify the difference between expenses that must be in your bank account and expenses that you could pay with a credit card. And I say that with a great deal of caution because 0% introductory rate will quickly turn into 22.99% interest. And all of a sudden, that $5,000 that you had on the credit card, it's going to start building up where like, every year it's going to increase by more than $1,000 if you don't have a plan to pay that down. Um, that paying it down is part of the second segment, the second bubble or world that you'll be in. Um, but right now it's just about survival. You got to get there. You got to get to the first paycheck. So whatever that difference is between cash on hand, how much you need to stretch between now and your first paycheck, what's that difference? You may have to figure it out with a student loan or not a student loan, sorry, with a 0% interest introductory credit card. You could also potentially apply for a private loan. Again, a company like Laurel Road and others like SoFi, Discover, they do offer private loans. They're not going to offer a 0% introductory rate, but it's going to be um, it's not going to generally be as high of an interest rate as a credit card would. Like the Chase Freedom card, that's the first 0% introductory rate credit card I think of, and it's a good short-term solution, but eventually the rate gets very high. So there's some pros and cons to those choices. If you go the route of the 0%, you just have to figure out how much you're going to borrow and then stick to that. You got to not think this is just available money and I can justify doing some more things. If you've already made a plan that is that is going to meet your needs between now and when you get your first paycheck. Do your very best to stick with it. If you do that, then you have a known debt amount from the credit card that needs to be paid down, usually in 12 or 18 months before that 0% interest rate goes away. And that just becomes part of your month to month cash flow activity. And so now we'll jump into that. You're going to get your paycheck. You're not looking at, if you're making $60,000 a year, your paycheck is not $5,000 per month or $2,500 every 2 weeks. You're looking at around 20% of all your income going to taxes. And so, if you're at 60, you're really more at like 48,000. So like $4,000 per month. And so that's the first thing you need to do is figure out what's the real number that's going to actually hit my paycheck. And there's several good online paycheck calculators that you could implement. Find out what your gross salary is for as a PGY1 and base your beginnings of your cash flow plan on that. An effective cash flow plan is bringing together all the information that you can about money that's coming in and money that's going out. The money that's coming in is your paychecks, and it's so important to know what you're actually getting after taxes are withheld, because that's the number that really matters. That's the money that you can do something with. And let's say it's $4,000. Now on the other side, the expenses, the money that's going to be going out, some of that might be repaying the 0% interest credit card that um, 0% interest credit card that you used to bridge the gap prior to your first paycheck, right? Um, whatever those expenses are, you got to tabulate those using like a Google Sheet. Something free is totally fine. You just need a spreadsheet where it's easy to line up all your fixed expenses, your rent, your mortgage payment if you bought a home, car payment if you have one, lease payment if you're leasing a car, and then how much you plan to spend on groceries, going out to eat, uh, getting gas for your car. If you you're probably gonna, if you haven't already, you'll get to a point where you'll know what your what your time off options are going to be during this coming academic year, and you'll want to try to set aside funds for that. I'm a big fan of spending some money on the limited times when you're not at work. I mean, sure, sometimes I'm sure you are just going to crash, and just falling asleep doesn't cost anything, right? But the I know a lot of trainees that get a lot of refreshment from going somewhere, getting outside, and surely there are things you can do for free to get outside, but a lot of times it's going to cost some money. And if you can build in your budget where I'm going to set aside $150 per month into a separate savings account that will be for me to do something nice for myself when I've got that week off to go visit family or go hang out with friends in February or whenever you're going to do that next year. The By doing that, by building that into your cash flow plan and viewing it as an expense, when it comes time to spend the money, that is not like a month to month thing, it's like a going on vacation thing or something like that, then when the money is there and then you can just use it and it doesn't suddenly plunge you into credit card debt and then you're like, okay, things are especially tight this month. The the mental health difference is massive. It's so much better if you can get that. Now I'll give you a very, you got to take all this with a grain of salt. I know like some of the numbers I'm throwing at you, they're just very hypothetical or arbitrary, I should say. So there may very well not be the ability to save very much per month for, a long weekend vacation. That might be very limited for some of you. Um, but from a habits building and principle standpoint, you want to figure out what is available in your situation. If you've identified your expenses and you know what they are, then what you can do is see the income minus expenses equals what's left over. Is there something left over? Are you spending more than you're making? If that's the case, let's look at the expenses. Are there some things here that I could adjust? Are there things here that I don't need, that I don't use? Make adjustments in accordance with the answers to those questions. Now, if you do have some savings after your expenses, then the question is, what do I do with this? Putting a little money aside for a long weekend, that's an example of something you could do. Another thing is building up emergency savings. You may have heard that an emergency fund is really important, and it is. You're not going to be, in most cases, residents aren't going to be able to build up a ton of cash. Like you may hear like, oh, it's ideal to have 3 months worth of expenses or 6 months worth of expenses in an emergency fund, which is basically just a separate savings account. The money sits there in cash and it's there if an emergency happens. Someone in your family unexpectedly dies. You get in a car accident. Insurance is going to pay for it, but you got to pay the deductible. The money to pay that deductible is an emergency. Those sort of things, they will come up at some point. So building up cash for emergencies is wise, but the amount that you can save is going to vary. I usually recommend aiming for $1,000 at first. 3 months of expenses sounds great. But if your 1 month of expenses is $3,000, that's $9,000. And that's quite a bit of cash to save up when your after tax pay could be, like $55,000 for the whole year. And most of that is going to go toward paying for life. So being able to build up $9,000 in cash would be prohibitive for most residents, I would think. So start smaller so that you don't get discouraged. Try $1,000 and then and then go from there. There are other competing priorities and we'll talk about this in our next segment after Larry about investing, but you want to first start with what is my income? What are my expenses? What's left over? Try to automate any of these payments that you can so that you're not having to manually manage cash flow because you're going to be so busy, right? Um, and then as far as building up cash for emergencies, you could also automate that. I really like Ally Bank, ALLY.com. It's a great place to keep savings. There's no fees associated with the account. It earns a high yield or high interest rate, which right now is about 3.2%. And you can create subcategories within one savings account to be able to label your money for different purposes like emergencies, vacations, etc. You can automate sending whatever, $100 a month, $200 per month into this savings account. So it's separate from your checking account. It helps for it to not be mixed in there with your day-to-day spending stuff because then it gets lost and it absolutely gets spent. But if it's in a separate account, then mentally we think more like this is something that is not for me for now. This is something else. This is something for me for later. And so anyway, I find that very helpful. This is the way to manage cash flow. We'll talk more about investing soon, about what you could do to stack on top of your cash flow plan. But I am just about to turn things over to you, Larry, if you're ready.
I am ready whenever you are, sir.
Okay. All right, everyone. So this is Larry Keller. He is a top expert in disability insurance decisions, specifically as it relates to the career paths of you physicians. Pay close attention to him as he talks about the important decisions surrounding disability insurance. Go ahead, Larry.
Awesome. And I'm going to keep this pretty high level. And I'm going to agree with you, Tyler. Normally, I am not a big PowerPoint person, but usually that is what people want to see, or they might want to take some notes along with it. So I'm going to throw that in there, and we'll go ahead and we'll use our PowerPoint here. So let's get this thing rolling. And we'll go from the beginning. Okay, so there's not a tremendous amount of things that you really need to know about disability insurance. I'm going to hone in on how to avoid some of the mistakes that I commonly see that really just should not be happening for any number of reasons. So we know disability insurance is just designed to cover what you don't have yet, which is a substantial net worth or a substantial amount of assets, right? If I was to ask you now, it all comes to this and it comes to this. If I was to grab you by the ankles and hold you upside down and shake you, odds are pretty good. The only thing that I'm going to find is a whole bunch of IOUs in the form of student loans, maybe a little bit of lint, really not much else. So it's all about protecting our financial future. So let's say you do what most of us do. You go to the internet, maybe you type in, disability insurance for an OBGYN or disability insurance for OBGYN resident, and you find a bunch of sponsored links on the top of the page. These are people that are paying to be there. You start inputting your name and your date of birth and some information in there. And lo and behold, you get a spreadsheet, which is something that is not created by the insurance company. It's created by the agent. If you start seeing the logos of the different insurance companies on there and columns with very limited information, I can tell you it's designed to have you make a very quick decision based on limited information to ultimately have you go with the lowest cost policy. Now, is that going to give you the best result? I'm going to say most of the time, it's not. If it happens, it's probably more by accident than anything else. Like everything in life, you have to know who you're talking to. Internet agents, as I'll call them, are very good at sending out spreadsheets, making policies look like they're easy to compare, and again, having you try to buy something at the lowest cost. You really want to ask two main questions at this stage of your career with any disability insurance agent you might be speaking with. Number one, before we even start this process, can you tell me if you have access to something that's exclusive for my benefit, like a discount, or more importantly, a guaranteed standard issue plan or a GSI plan? This is a policy that you can buy with either no medical underwriting at all or a few gatekeeper questions just to make sure that you are eligible and you qualify for this policy. A massive caveat is in many circumstances, if you apply medically, where you're answering medical questions, you are letting the insurance company review your prescription drug use history or review your medical records, and you are declined coverage, or you're offered a policy with modifications. Maybe they'll cover you for something, but we're going to exclude your right shoulder because you had your right shoulder reconstructed, and in there you've got some pins, screws, and anchors. Or you're told that things are not going well and you should withdraw your application. In most situations, you have now become ineligible for the guaranteed standard issue plan. You need to leave your options open. So let's say you get no, I don't have access to something like a discount that's exclusive. I don't have access to a GSI plan. Then you have to go to the second question. I hate to do this to you. I don't want to start off on the wrong foot, but I really need to evaluate all of my options. Do you know of something that is available, like an exclusive discount or a guaranteed standard issue plan? I would like you to provide me with the name, phone number, and email address for that agent. I'm not telling you that that's the route I'm going to go, but I do need to take this into consideration before I make a decision. And this is a big decision. Uh, Go to a specialist. I can assure you, people that do this every day are going to lead you to either the ideal result or closer to the ideal result than someone that does not do this every day. I see it happen either inadvertently, the agent is new or new to the medical marketplace and they just don't know what they don't know. And the one that is harmed as a result of it happens to be you as the individual looking to buy a policy. We're going to talk about the big five. We're going to talk about finding the right disability policy. Really is easy as one, two, three. So very quickly, what do I look for in a policy? I look for a policy that is non-cancelable and guaranteed renewable. The insurance company can't take it away. They cannot change the premium rates. Once I'm in, I'm in. I can get rid of the insurance company. They cannot get rid of me. If you are offered a guaranteed renewable only policy, that means the insurance company can change the premium based on class of policyholder. My opinion is this is not a very good option. You've got a substantial career ahead of you, 20, 30 years. The insurance company would have to go to the Department of Insurance to get an approval for an increase. If it happens, that's going to get passed right along to you. The savings is insignificant compared to the guarantees associated with both a non-cancelable and a guaranteed renewable policy. Probably the biggest area for a physician is the definition of total disability. And we're going to talk about this. You want an own occupation definition. You want to have a residual or a partial disability benefit. You certainly want to have a recovery benefit if your future is tied to production, or you're just not a straight employee where you get paid what you get paid. Doesn't matter whether you see one patient or 100 patients. Your pay is your pay. Even if that's your situation right out of training, it doesn't mean that your situation is going to remain that way. So your policy should have a recovery benefit that's unlimited to allow for changes in your career. We want to have our cost of living adjustment rider, and we want to have a future increase option rider. So let's talk about own occupation. Well, sometimes you'll hear your policy should not only be own occupation, it should be own specialty. Technically, that's not correct. It comes down to your job duties, not your job title. If you look at something like an ophthalmologist, there's only one board for ophthalmology. You might have done your ophthalmology residency. Now you did a fellowship in retinal surgery, and all you're doing is retinal surgery. Well, you don't want your policy to cover you as an ophthalmologist. You want to make sure that that specific policy is covering you as an ophthalmic surgeon or a retinal surgeon. So it's based on the duties that you were performing prior to your disability. And we talk about the material and substantial duties. If you can't do that, even if you can work in another occupation or another medical specialty, full benefits are going to be payable. Because you're just starting training, you might be doing something like a preliminary year in general surgery, but then you're going to be doing interventional radiology, or you might be doing general surgery and then you're going to do a plastic surgery fellowship. You do not need to notify your agent or the insurance company when you are making these changes. The policy is going to be based on what you were doing immediately prior to your disability. This means if you become disabled and you cannot work in your regular occupation, you can do whatever else you want. You can earn as much money as you want, and it does not matter. Now, one caveat here is if you're doing a preliminary or a transitional year. So let's say you've matched into anesthesia and you're doing a preliminary year and an agent or broker tells you you should say you're an internal medicine physician. The rates are lower. Well, that is true. The rates are lower. You matched into anesthesiology. I could probably go onto Facebook in 2 seconds. I could find a picture of you holding up the sign that says that you matched into anesthesia. You need to be honest with the insurance company in the way you answer these questions. If not, your policy can potentially be rescinded as if it never took place, and you get all of your money back from day one, and your claim would not be paid. So be careful. The companies that offer an own occupation definition are Berkshire, which is Guardian. You can use that interchangeably. Standard Insurance Company, Mass Mutual, Principal, and Emeritus. These are known as the Big Five. To that, you can add Northwestern Mutual and New York Life. Now, Northwestern Mutual, for a very long period, did not offer an own occupation definition to physicians. This was from September of 1997 until December of 2022 is when they began offering it again. So you need to look at any policy carefully. And just because the definition of disability is available from a company with own occupation does not necessarily mean that is the definition that you are actually being shown or ultimately going to purchase. Well, Guardian came up with something about 7 years, 8 years ago at this point. And when you are dealing with hybrid occupations, let's say a urologist, we'll go back to our ophthalmologist, an OBGYN, uh, an issue becomes that you are performing both clinical duties and surgical duties. And a lot of people will say, well, what happens if I'm disabled and I can't operate, but I can still continue to do my clinical duties? Well, that's typically going to be viewed as a partial disability claim. I have my clinical side and I have my surgical side. And if it's viewed as a partial claim, you're going to get paid benefits based on loss of income. Well, the problem is if you were a surgeon on one side and a clinician on the other side, and you could no longer operate, but you could still work in the clinic, your income from the clinical side is going to increase, and your loss of income from the inability to operate is actually going to decrease. And if they're paying you based on loss of income, and you get to the point you no longer have the required minimum loss, you literally might find that your payments end. So Guardian says, before we tell you this, let's take a quick step back. Prior to your disability, was more than half of your income derived from performing invasive or surgical procedures? If the answer is yes, full benefits are payable, even if you stay in the same occupation, working for the same employer, but you're no longer qualified or eligible from a medical standpoint to do the surgery. Now, don't worry, if you're not a surgeon and you happen to be very entrepreneurial, and let's say part of the time you were working as, Jeff, I guess, a pediatric anesthesiologist, but you were making your transition to working as a financial planner, and you had income coming in from both sides. And unfortunately, you're disabled to the point you can no longer continue to work as a pediatric anesthesiologist, but you're going to continue to work full time as a financial advisor. We would take the step back and say, Jeff, prior to your disability, was more than half of your income derived from performing hands-on patient care, where you were interfacing with the patient to diagnose and treat them? Well, yes, I was making the transition, but yeah, I was still 60% on pediatric anesthesia. The balance was financial planning. Well, you've met the test because you've lost more than 50% of your income. You can't do the hands-on patient care. You can now do 100% of your work as a financial advisor, even if you have no loss of income and full benefits are payable. So this can be important if you're very entrepreneurial, if you are in a hybrid medical specialty where you're doing both surgery and clinical medicine. Just know that the definition of disability is important. Northwestern Mutual has a definition that is similar with a 50% threshold as well. The big difference is in order to get full benefits, if you can do some, but not all of your job duties, and more than half of your income was derived from hands-on patient care or performing surgery, they will give you the ability to discontinue gainful employment. And if you do that, full benefits are payable. Guardian says you can still work, you can still do those duties, and if you're not doing the surgical side or you're not doing the clinical side, and more than half of your income was derived from that, full benefits are payable even if you are working in another capacity. Here's our residual or our partial benefit. This takes away the all or nothing of a claim. Many disabilities are gradual and not immediate. Generally, you need to have a percentage of your income lost of either 15% or 20% or more. And if you lose more than 75 or 80% in a given month, you get everything. And here's kind of what I talked about before, the recovery benefit. So let's say I was out of work for a year. I'm an aesthetic plastic surgeon in my own practice. When I'm there, my patients look great and my patients love me. But now I'm disabled. Botox, Restylane, Juvederm, it wears off after a period of time. My patients are not liking what is happening to them in my absence. They know that I'm not there. They don't know when I'm coming back or if I'm coming back. So they find another plastic surgeon. I now return. I look great. I'm more well rested than I've ever been. I have no loss of time. I can do everything I used to. I have no loss of duties. I can do everything that I used to for the same amount of time I used to. The only thing I still have is a loss of income. As long as that loss of income was tied to my prior disability, I will continue to receive benefits under the recovery benefit. You need to be careful here because some of the companies have a limited recovery benefit that ends after a period of time. So just be conscious of that. Cost of living adjustment rider, there's nothing sexy here. It just increases your benefit after disability has lasted for a year. If you're disabled very young, this can be really, really important. So for me, given the choice as a resident of buying a bigger policy without the inflation adjustment or a smaller one with it, you really want the smaller policy if you plan on building onto it as your income rises and as you move along in training. Conversely, if you're already practicing and you're mid to late career and you had this in your policy, it's not necessarily as relevant as it was when you had your long career horizon ahead of you. So other than price, what should we know? How are claims handled for mental or nervous conditions? How are claims handled if you're disabled and you choose to reside overseas? And then what type of increase option do you want in your policy? So mental or nervous conditions, this gets talked about a lot, especially with wellness programs in residency situations. Well, when I talk about psychiatric, I am solely speaking about anxiety, depression, stress, chemical dependency, drug addiction, or burnout. Most of the policies out there have a limitation for these types of claims. They'll typically pay you for 2 years, either over your lifetime or per episode of disability. Well, when it comes to this, I find that there's two schools of thought. I made it this far. I don't have a personal history of this. I don't have a family history of this. I am not very concerned. If my premium is going to be lower, I'm happy to take a limitation along with a discount. Other people say, I don't know what I don't know. I don't think that this is going to happen to me, but I can't predict the future. If an unlimited option is available where a cancer claim or a major depressive disorder claim is handled the same, I'll happily give up the discount for unlimited coverage. There are certain medical specialties that you cannot have unlimited coverage. Anesthesiology, emergency medicine, in most cases, pain medicine. All of policies in the state of California have this limitation. And in the state of New York, all of the policies with principal have this limitation. So again, just know what it is that you are looking at. If you happen to have medical history, and a lot of residents and fellows are in therapy. They're using an SSRI. They have ADD. They have ADHD. They're on Vyvanse. They're using Adderall. Typically, this is going to get you an exclusion rider or no coverage at all for these types of claims. This is where a guaranteed standard issue plan can be extremely beneficial. If you're a visa holder, so you're here, you're doing your residency training, and God forbid you're disabled. You lose your sponsorship and you have to return to your country of citizenship. You really need to know whether the policy is going to continue to pay benefits to you, or benefits are either going to not be paid or they're going to be paid on a very limited basis if you return to your country of citizenship. The states that are less liberal for this are here: California, Delaware, Florida, Montana, North Dakota, New York, South Carolina, South Dakota, and Wyoming. Guardian is very favorable for visa holders. Outside of these states, Guardian says, hey, if your disability started in the United States, you've lost your sponsorship and you need to return to your country of citizenship, we will continue to pay you with no limitation. The same is true if you were visiting family, you were outside of the country, tickets were booked, and your tickets to come back to the United States were within 31 days of your leaving. Something happens to you overseas and you cannot come back. Guardian's policy will still pay you with no limitations. So the spreadsheets that I have seen, none of them ever bring up what happens if I'm disabled and I want to leave the United States. The same is true with non-visa holders. You could be a permanent resident or a U.S. citizen. Maybe you have a spouse that's from another country and they have family in another country. And if you are disabled, that's where they're going to want to move. You need to know what your policy says in the event that you would like to reside outside the United States. Not going to spend a lot of time on this. Future increase option or benefit increase option. There's two different ways to get to the same end result. The future increase option, or the FIO rider, you're paying for the right to be able to increase your coverage in the future. It comes up every year. Because you're paying for this right, it's nothing you can lose. You can choose to use it or not use it. It's totally up to you. You're not required to do anything administratively. You're not required to purchase a minimal amount of coverage for this to remain on your policy. In most cases, this gives you more flexibility. In some cases, this gives you more guarantees. If that is the camp that you're in, administratively, I'm terrible. I'm never going to really want to be involved in this, but I might wake up one day and I want to increase my coverage. You are much more likely an FIO rider person. But then you have this benefit purchase rider or benefit increase rider or benefit update rider. This is a no cost increase option, and you can reach the same or even a higher level than you can with this compared to the FIO rider. Like I said, you don't pay for this, but this does require that you check in with the insurance company every 3 years. And if you qualify for more coverage, you must purchase at least half of what you're eligible for. If you do not check in at all, you're going to lose your increase option. If you're eligible for more coverage, let's say an exception, you're still in residency or fellowship, and you're offered more coverage and you don't buy at least half of that, you're going to lose your increase option. My rule of thumb and what I have seen, the earlier you are in your training, the longer your training period, the more likely you're going to want the rider that starts with a B, because you're not paying for it and you don't have to pay for an option like the FIO rider for something that you're not going to be able to use for several years at the time you have the least amount of money. If you're in California now, I would wait. I would not buy a policy there today. You're going to be outside of California in the not too distant future. California is the most expensive state. You have limited policy choices. The provisions are less liberal. If you plan to move there and you're not there now, you should look to buy your policy before you get there. And like I said, conversely, if you're in California and you're getting out of Dodge, I would probably wait to buy my policy. The big take home message is kind of what I said in the beginning. A guaranteed standard issue plan could be your saving grace, either because you're super busy, you don't want to answer medical questions, you don't want to fill out a lengthy application, you don't want anyone looking at your prescription drug use history, you don't want anyone reviewing your medical records. But if you have medical history or any of these things on the list, this will immediately steer you to the direction of a guaranteed standard issue plan. You guys are early, but do not self-prescribe. Do not have your friends prescribe for you with no medical records. Small stuff is okay, a Z-Pack or something like that. Anything beyond that, you're likely going to get declined or not offered coverage at all because of self-prescribing or having a peer or your spouse prescribe for you with no medical records. If you're currently pregnant or you have a history of infertility, you're going to typically get an exclusion rider, no coverage for pregnancy or complications or infertility. If you have PCOS, if you have ADD, ADHD, if you have diabetes or prediabetes, if you recently got stuck with a needle and you did not have a 6-month post-exposure negative HIV, hepatitis B, or hepatitis C test, you're going to get an exclusion rider for blood-borne pathogens. If you had recent surgery or you had surgery where hardware was placed and it's there, you're going to get a permanent exclusion rider for that body part. History of cancer, if you're seeing a chiropractor, I guarantee you, you might tell me it's just a free massage. I want to make sure that I'm in alignment. I need to extend my career length. It's not going to cut it. When we look at those records, I can all but tell you it's not going to say that. If you have psoriasis or worse, psoriatic arthritis, you're going to get an exclusion. On the arthritic side, it's a 50% extra premium charge, no coverage for psoriasis or psoriatic arthritis, and no increase options. If you have sleep apnea or another sleep disorder, colitis, Crohn's, any of those things. So if your medical history is anything other than unremarkable, you need to find out about a GSI plan. And again, no medical history questions, at worst, some gatekeeper questions. BMI is not taken into consideration. Hazardous activities are not taken into consideration. But the big caveat is this might not be available if you were previously declined for individual coverage, you were issued a modified policy, or you withdrew a pending applications. There are exceptions, but you don't want to find out after the fact. You want to do your homework up front. Same benefits of a standalone policy. Policies are portable. This is a QR code to a blog post that I put together talking about residents being robbed of guaranteed standard issue disability insurance and their ability to protect their income. So since these GSI plans are exclusive to particular agents or groups of agents, a lot of times non-program owners or non-endorsed agents are going to steer you in another direction. They cannot get paid. If they have the ability to offer it, they're going to get paid less. So it's in their best interest to take you away from a GSI plan or to have you not want to consider a GSI plan. The cost is the same as a fully underwritten policy. In some cases, they're even less expensive. And as we finish up, the biggest thing physicians love is statistics. If we look at the 2025 Milliman Annual Disability Insurance U.S. Market Survey, of the applications that came in, 53% were either declined or modified. 19%. So 1 in 5 physicians is like, you want us for disability insurance? That's great. We don't want you. 34% are getting modifications, exclusion riders for specific body parts or hazardous activities or medical conditions. Don't let this happen to you. It does not need to happen to you. So my big takeaway is you have worked hard to protect the investment that you're making in your career. Every individual is different. Insurance is not one size fits all. Unfortunately, not everything in life is under our control. Most people do not plan to fail, but they do fail to plan. And if you're going into a surgical specialty, you would never go into that surgical specialty and not have a surgical plan. So if you need me, this is how you find me. Email is long but easy. It's lkeller@physicianfinancialservices.com. Phone number 516-677-6211. Use me as a resource. Hey, Larry, I'm looking at this, or someone proposed this, or I have this policy. What do you think? Did I do okay? Did I not do okay? Could I do better? I'll end with, unlike medicine, where you could charge anything you want. And if you're a plastic surgeon and you're doing a mommy makeover and you're charging $100,000 for that, and your market is willing to pay that because they believe you can provide the ideal result, that's great. When it comes to insurance, it's a heavily regulated industry. Whether you buy it from agent A or agent B, if things are structured the same way, the price is the same. So it's going to come down to agent knowledge, agent experience, especially in terms of paying claims, and do they have access to something exclusive like a discount or, more importantly, like a guaranteed standard issue plan? So let's be careful out there. That is the number one question that you want to find out. I'm matched. I know where I'm going. Is a GSI plan available to me? Do I need that? And if I need it, it's important that I know about it. And if I don't need it, it's important that I know about it as well in case I might need to fall back to that. So let's do that. And let's get larger here. So questions jumping out. A lot of stuff in a short period of time. But the nice thing is it's going to be recorded. And again, you always have us as a resource. So questions jumping out.
Yeah, go ahead.
Hi, thank you so much for such an incredible presentation. It was really, really insightful. My question is this different from like when we're onboarding with our residency program, we sign up for our medical insurance, our dental insurance, all of that. But part of that is short-term disability insurance, and we can elect into long-term disability insurance. Are those separate from what you just talked about versus like the stuff that we get from or what we can elect to in our program?
Yes. So what you'll find is we happen, by we, I mean the insurance companies, we love residents and fellows. And we know that your potential is substantial. So if we said, we're going to look at your actual residency income, we're going to take into consideration what you're opting into or what's provided to you by your residency program, and we're going to go ahead and offset the amount of individual coverage that you can buy, you probably would be thinking, well, then what do I need to buy anything for? I don't need to buy a minimum policy. I need to buy something that's going to adequately protect me. So for new residents, insurance companies will allow you to purchase somewhere between $5,000 a month and $7,500 a month of benefit. Now, don't be scared. This is not what you're paying. This is what you would be paid in the event that you were disabled and you met the definition of disability. So this is going to be in addition to your employer provided or employer sponsored group long-term disability plan. So you could safely opt into that, no problem at all. And this will sit on top of that. The big difference is what they provide to you is not going to be own occupation in the situation where, let's say I'm an OBGYN resident, I'm disabled, I can no longer perform my job duties as an OBGYN resident. I can go work in another capacity using my MD or DO or MBBS, and I can make more money than when I was working as an OBGYN resident and still get my full benefits. That will not be the case. The individual policy will still pay you, The group plans are going to have offsets for something like workers' compensation if you get hurt on the job or you get Social Security disability. The individual policies are not going to do that. And finally, it comes to portability. So the good news is you're not disabled. Life is great. You finish your training. You're moving on. You take this policy with you, just like your luggage. You make increases to it, taking into consideration your income and let's just say future coverage as an attending in your new practice or hospital. And a lot of times people will say, well, if I'm eligible and I buy a GSI plan because I'm working at XYZ hospital, does that mean I lose it when I leave? The answer is no. The barrier to get the GSI is you're working at that institution that has a special GSI offer. But once you have it, it's your policy to take. You keep it, you take it with you wherever you go. Does that help?
Yes, so basically, the recommendation is still elect into the disability insurance that the hospital offers or add on to it, and then still go out and find another disability insurance that offers own occupation.
Yes, most of
Okay.
the time for residents and fellows, they're going to give you the long-term disability policy as part of being a house staff member. I really haven't seen it very often where you actually have to pay for this as a resident or fellow. If you do and you want to elect it, that's okay. It's not going to offset your ability to buy the individual policy. But if you want to, you can go into that. It's provided to you by your institution. You can buy as much as $5,000 to $7,500 a month individually, and life goes on. And some people will say, well, it seems crazy. If I become disabled, I'm going to make more money as a disabled resident than if I actually continued to work as a resident or fellow. That's true, but we are ensuring your income protection and your income potential in your specialty, not so much your income today. Does that make sense?
Yes, thank you so much.
You are very, very welcome. Next question, if we've got.
Can you talk about whether the timing of when we select one of these policies, if that's important? I mean, I was assuming that I would sort of start around when I was starting intern year, which is
Mhm.
July 1. Is there anything that I'm missing in terms of the timing?
Really, the biggest thing is just because you've matched, even an MS3 or an MS4, they can buy disability insurance now. The big thing for you is, hey, if I match to a place that has a GSI plan and I know I want to get that GSI plan, then you actually have to be working at that institution in most cases in order to buy that GSI plan. So let's look at something like Emeritus, one of the companies that offers a GSI plan. So let's say you apply medically. You go to principal, you apply for coverage, and unfortunately, you were declined. Now you go to your residency program and you find out, hey, this is awesome. There's an emeritus GSI program there. I want to go ahead and buy this. Emeritus is going to ask you if you've applied for disability insurance previously and have you been declined, modified, postponed, or offered a modified policy or withdrawn an application. If the answer is yes, you are now ineligible for that emeritus GSI plan. So with emeritus, you have to be careful if the GSI plan is there because if you apply medically, there's no exceptions to the rule. Even if you apply to emeritus medically and the emeritus company is the one that has the GSI at your institution, you're now ineligible. Standard insurance company, they say, have you been declined previously? If you were, you're ineligible. Guardian has a rule. Guardian says if you apply to us, even if you are declined, postponed, modified, you withdrew a pending application, you're still going to be eligible for the GSI plan. And if you applied somewhere else prior to your starting date where the GSI plan lives, we're not going to hold that against you. You're still going to be eligible, including up to the first 9 months after your hire date. So it becomes very specific. Where are you going? Where are you now? is there a GSI plan available to you? If it is, which company has the GSI plan? Because you don't want to sacrifice your eligibility for that GSI plan by applying too early. So, rule of thumb is if I'm not in California and I'm going to California and I'm in good shape, I probably want to apply before I move to California. But if I'm going to California and I've got medical issues and there's a GSI plan there and it's not a Guardian GSI plan, I don't want to apply and I want to wait even to get to California, even though it's more expensive, because that GSI plan awaits and I don't want to negate my eligibility for that. It could be my shot at the brass ring at the carnival. Does that help?
Yeah, that's very helpful. One quick, or hopefully quick follow-up question I had to that. So,
Sure.
medical school was a second career for me. So prior to that, I bought a term life insurance policy that had some medical, I answered medical questions and stuff. Does that
Yes.
sort of evaluation exclude you? Like, is there crossover between the term life insurance policy and disability, in terms of the application exclusions that you just mentioned?
No. So you could literally have been declined for life insurance. Now you go and you apply for disability insurance. They're looking at the difference between mortality and morbidity. So I've had people where they get the best class in terms of term life insurance, and lo and behold, they're uninsurable when it comes to disability insurance. So being declined for a life insurance policy is not going to impact your ability to get the guaranteed standard issue disability insurance policy. Does that help?
Thank you.
Perfect. Thank you.
Um, Ronnie had a question. He and I've heard this too, so from others too. So I thought it was a good question. Sounds like Guardian is the most physician favorable company at the moment. Is that accurate?
Yes. And I think almost not at the moment. Historically, if you were to poll other physicians or financial advisors or insurance agents, you would typically hear everyone is comparing whatever it is that they're offering to Guardian. So Guardian's kind of always been known, at least over the last 15, 20 years, as the gold standard. Guardian can also be extremely difficult when it comes to medical underwriting. So, from a contractual standpoint, no one's going to argue, hey, Ronnie, is Guardian the best policy? From a contractual standpoint, the answer is almost always going to be yes, it is the best policy. I say almost always because there's always going to be an exception somewhere, right? So you can't go for that. But from an underwriting standpoint, they can be very difficult. So what have they done over the last 3 years is they've dominated the guaranteed standard issue marketplace. They've taken what could be a very difficult situation when you go to buy a policy, and they've made it very easy. So you get the strongest contractual language with no pre-existing condition limitations, with no medical questions for the best contract. So these days, they are definitely the forerunner in terms of not only contractual provisions, but in terms of if your institution has a special GSI offer, the availability of getting that coverage becomes very, very simple. It's kind of like eloping rather than going out on this whole drawn out dating process.
Very good. Thanks, Larry. Yeah.
Awesome. Thank you.
Other questions? Anybody else? No? Okay. All right. Well, let's jump into our last segment.
Tyler, do you mind if I do a follow up from the for the group from the small group? So,
Yeah.
question had come up. Someone spoke with a med student, and they said, "Hey, don't consolidate your student loans because if you don't get them consolidated by July 1st, you won't be eligible for IBR." Now, here's some ambiguity. For IBR, it's only available for loans dispersed before July 1st, 2026. Okay, everyone in the room, we got that. The second part is loans, including consolidation loans made on or after July 1st, are not eligible for IBR. Now, the challenge is this. Let's say you graduate, you put in your application to consolidate, it goes through before July 1st, it gets processed, and then you're able to get into IBR. The challenge is if it gets processed and it falls after July 1st, even though the original loan disbursement dates were not after July 2026, the servicer may consider that a new loan after 2026 and not let you into the IBR. So here's welcome to, the dumpster fire, right? Do I try and consolidate and go for IBR and get more $0 payments, or do I go ahead and wait for the grace period to go by and then just start paying on the loans under an income driven repayment plan because they're still going to be older plans? Do I miss out on those months? And I don't think that there's like a real clear answer. The challenge is if you consolidate and the timing of it hits in such a way, it might lock you out. Now, what if I don't consolidate and I just do like income driven repayment plans? That will fall under all the loans. You'll get credit for all the PSLF payments that you make. So that is a challenge with student loans. Again, we're going to have to, like you all are going to have to make a decision, and you won't know if it's the right decision until perhaps 6 months or a year later. And so it's interesting in a lot of the talk online for new med students, like med students that are coming out and graduating, that hasn't really come up. It came up in this one thing and is a theoretical risk. I don't know how likely it is to happen. Tyler, do you know if you read anything, or or do you have any thoughts on it?
Um,
Not to put you on the spot, but
oh, I don't mind. I I don't think I'm in a position to answer it. I don't want to. We'll have to do some research. You know what? Why don't we, what we should do? We could research the question, and then you could do a podcast episode with me, and then we could
okay.
put on there.
Yeah, let's do it.
Okay. All right. So
Yeah.
yeah, great questions, you all. I've got a podcast called A Good Problem to Have. It comes out weekly. I've been doing a mini series on these very topics that we've been talking about today, and obviously continuing that into the spring and summer. So Jeff and I will record something on this topic and other student loan related stuff, and then you can listen to it there.
That's good.
Yeah. Okay. All right. So, yeah, our last segment that we were going to talk about was investing for trainees. Um, as we talked about earlier in the section about cash flow, you've got your segment of money that whatever that amount is, that's available for saving up for emergencies, saving for extra things like a little time away. Investing is also an option. You, my favorite go-to investing starting point is if your program offers a 403(b) plan and they offer the option for you to contribute on what's called a Roth basis. ROTH. Roth means you pay the taxes on the money that then subsequently goes into the investment account. But then it grows tax-free all the way up into retirement, and you don't pay taxes on the growth or the distributions or anything from here on out. When you're in a lower income environment, you pay lower taxes, and so Roth contributions are more optimal than they will be when you're an attending. So that's why I say the Roth 403b through your employer is great. And the reason why I say that even above and beyond the Roth IRA is twofold. One, you don't have to set up your own account. It just runs through payroll. It gets taken out of your paycheck, and you don't have to really manage anything. The second is that if you happen to be married or you will be married, and you are thinking that because of student loan decisions, you may need to file your taxes separately, contributing directly to a personal Roth IRA is not possible. When you file your taxes married filing separately, you cannot contribute directly to a Roth IRA. You have to use the backdoor Roth method if you're going to do it. But that's just more complexity. And you may very well not have the time for that these days. Whereas if your program's 403b plan offers a Roth option, it's super easy. It doesn't matter whether you file your taxes jointly or separately if you're married. It's it The Roth 403b doesn't face those same rules as a personal Roth IRA. But in any event, doing so, um, getting in the routine of investing something, even if it's something modest like 1% or 2% or 3% of your paycheck, is a good way to get used to separating yourself from some money that's going to be for long, long in the future. Then when your income rises after training, that routine, it doesn't change in the steps. The dollar amounts definitely change, and that's a good problem. But you want to have the routine of, hey, I'm setting aside money every paycheck, every month to divert away from my checking account, the black hole that is the checking account. Um, that's yeah, so that's my 2 cents on investing as far as those of you jumping into intern year. What do you think, Jeff?
Yeah. You, in your career, you are going to be pitched a lot of super sexy investments, and they're going to sound really cool. And it's going to be like, oh my gosh, well, because you're a physician and you earn the money that you earn, you have access to this that most people don't. That's how it's going to sound. And it's going to be like, I've heard it all. Like, you join a group practice and you're going to literally buy a jet as a group, and then you lease it out. Well, now you're working with this group, but now you're also investing with them, and it may not be a great idea, right? So, like I said before, part of your job as a resident is to get good habits, and one of those habits is investing. And I think that with Tyler, what I like about with the 403b, it automates a process so you don't even have to think about it. And especially if you get a match, it's like free money. Um, if you're doing income driven repayment, it might make sense to do traditional, which is pre-tax money, because then it will lower your student loan payments. But I would run numbers, because I've done this with clients before, and they said, well, I want to make the lowest dollar payment possible. We run the numbers on what they have in their budget for Roth versus traditional, and we look at it, and it's really doesn't make as much impact as I think it would. So that is a caveat. So instead of just saying, oh yeah, resident should always do Roth, at least look at the numbers. I mean, if you have a spouse that has a high income, it might make sense for you to put more money into traditional. But you've just got to kind of run numbers. And guess what? Not to paraphrase Tyler's podcast, but yeah, it's a good problem to have, right? If you're trying to decide Roth versus traditional. And you do need a little bit of each in your buckets for retirement. So it's all about like building that habit. And from a like asset protection standpoint, in most states, the 403b, the 401k is going to have better protection than the Roth IRA or a solo 401k. But depends on the state in which you live.
Yeah. Ronnie mentioned a couple things here too. Employer-based Roths can many times come with free money, the employer match. Yeah. So, 3% is not uncommon if they do offer a match. Don't be terribly disappointed if your program doesn't offer a matching contribution. It is not, I don't think a lot of programs offer matching contributions. Yeah. Yeah. And good point, Ronnie. Like target date funds, they're often the go-to option in 401k and 403b plans, and they're an easy way to get your funds invested without having to think about it. It's like a typical array of stocks, bonds, and those are types of investments, the details of which we won't delve into today, but they give you access to what is typically invested in, and then you don't have to do a bunch of research. So, does anyone have any questions about this or anything?
I had one more question. And I apologize if this has already been asked, but in my previous research about RAP versus IBR, I was admittedly confused given that I'm in part of the class that will be an intern July 1st. So that since we're sort of in a different bucket than like a class 1 or 2 or 3 years behind, my previous understanding prior to listening to you guys was that the IBR plan, even for my year, would be retired in a couple of years, and that RAP would be the only option for the federal student loans. Is that, and it sounds like that's inaccurate that I'm learning from you guys, but I just wanted to ask that explicit question.
So and this is as of, April 10th, 2026, what we know as of today, the IBR is available. We know that pay as you earn will be sunsetted, and they have what they now have called a modified IBR, income based repayment, because the old IBR had a like income. If you earn too much money, you couldn't be in it. You had to have some hardship, economic hardship to be in it. They removed that. So the IBR actually was literally an act of Congress to put through. So it's a little bit harder to like topple that income driven repayment plan. And what we think is going to happen is those people who are in IBR currently or can get into IBR will be able to stay in there for the duration. But that's like everything else in student loans subject to change. And that's the challenge of this little wrinkle of consolidation. If you graduated mid-May, you put in your paperwork, you consolidate to try and get payments started. And what if they process it, but it processes after July 1st, 2026? Well, they say, well, it's a new loan. You don't qualify. You have to go to RAP. Would it be safer if you want to like guarantee the IBR? It might be safer now that I've started like digging into this. Like it might be safer to not consolidate, wait for the grace period to end, and then just start paying in the IBR plan. But it's hard, right? Because we don't know the exact answer to it. But we think, to answer your question, we think some form of IBR is going to be around after July of 2028, which is huge because it has the payment cap. So you're not making like crazy payments on your student loans when you're attending, trying to go for PSLF, and then like you end up paying it off anyways, right? Did that answer your question?
Yes, absolutely. Thank you.
Yeah, it's not easy. Um, and here we're in the middle of giving a webinar on updates, and then this other new wrinkle comes in. Well, what about this? Well, we got to go search it out and check it out. So, um, we'll do a podcast on it, but there's no, like a lot of things with student loans, there's just no real clear answer because the system continues to change on us.
Yeah, it's incredibly frustrating, I'm sure, for those of you with money on the line. Okay. Yeah, what further questions do you all have?
I technically graduate, like my last day of classes is next Friday. Am I okay to consolidate next Saturday and that'll be enough time before July 1st? I don't know how long it takes.
Yeah, for Parent Plus borrowers, they were suggesting, and when they were only talking about Parent Plus borrowers, they're talking about April 1st. The challenge is you graduate, which, by the way, congratulations, graduating next Friday.
Thank you.
You'll have to go through um, your your loan exit interview, and then your school will have to mark you as graduated before you can consolidate.
Okay.
And so, the challenge is, what if you put into consolidate, and it may go through and the servicer may be like, oh yeah, this was an old loan. Like it qualifies for IBR. But what if you have a servicer who says, no, it's a brand new loan. We're going to count it as a brand new loan. And by those rules, and you'll know, you have some attendings that are like very much like that it says this, and you'll have other attendings that said, well, the spirit of it is this, and we don't know what we're going to get.
So
And
even
it's
before July 1st, it's
even July. Yeah, because I think what they're afraid of is if you were to like put in your application like June 28th, like there's no way they're going to like get to it in time with everyone else trying to consolidate.
but if I put it in my application next week,
Uh,
Well, you won't be able to.
well,
yeah.
after Friday, next Friday.
I mean,
I mean,
but even if it's going to take a while for your school to say you've graduated to even open it up for you to consolidate.
Oh,
like
okay.
there's usually like some sort of like every school has its own cadence of when they update the registry. And
And
so
Mhm.
sometimes it's been a couple of weeks after graduation. Sometimes they're like, we do it at the beginning of every month. So it might be May 1st that you could do that, for
or
example.
Okay.
may or maybe June 1st after everyone else graduates. I
Mm.
mean, that's the challenge.
I
I
would
mean,
speak with someone in I would talk with someone in like the office at school to be like, hey, when does this happen? I mean, someone has to do it.
Yeah, I
Might
have a
be,
meeting with someone next Wednesday, so I'll ask her like, when are you guys gonna mark us as graduated?
yeah. I mean,
you know, go ahead.
almost, working through this puzzle in real time, the safest route would probably be to not consolidate, hold for the grace period, apply for IBR. But again, they could change it on us, right? They may change it in after, it's so hard to tell you what the perfect answer is, and we won't know. You'll have to make a decision, and you won't know what the perfect answer is until like months after you have to make the decision. Does that make sense?
Yeah.
It's super frustrating.
Oh, thank you so much.
Yeah, yeah. I mean, I wish y'all's class is a little challenging because y'all are kind of going through it the transition.
Yeah.
So
All right. Well, I think that fairly well wraps us up. We really are glad that many of you came here to listen and learn. And if you need help with further questions, you know how to reach Jeff or me or Larry. Um, yeah. And I think that there are many good. I think that there are many good financial planners, not like unlimited. I know like Jeff, he does really good work. We try to do good work too. Um, we're here for you on like to like just answer your questions. So um, if you if you found me like because on Twitter or TikTok, you can always reply to posts and stuff to ask your questions, and I'll be happy to help. And Jeff does the same. Um, for analysis on your disability insurance, there are not very many great agents. Larry is one of the few. So if you need help navigating that decision, you should keep his email at the ready so that you can make the right decision for you at the right time. Um, and yeah, be sure to be sure to check out our upcoming podcast episode. Jeff and I will do one. And heck, Larry, you and I should do one. Let's plan on it. Because I'd love to pick your brain some more. Um, yeah, it's called A Good Problem to Have. And then I also have the other podcast that I co-host with Chad Chubb. He's another financial planner. That one's called Physician Sense. So there's plenty of places to get free financial education. So you just gotta jump in there. All righty. All right. Yeah, you're very welcome. Thank you for coming. Best of luck as you transition into intern year. I know it's a heavy responsibility, but you're gonna do great. Yeah, you're very welcome, Skylar. Have a great weekend. Right. Thanks a lot, Jeff. I appreciate your help.
no, thank
Have,
you. It's interesting wrinkle, right?
yeah,
And that's makes it super frustrating because there's not a real like what if you put it in and then it gets bumped and then that's it, right?
yeah,
Yeah. But podcast will be interesting on it.
yeah, yeah. Let's see. Maybe we could do that sometime in June.
Okay.
Hey, Mandy, would you mind trying to get that on the
Or
schedule?
is June potentially going to be too late?
Oh yeah, maybe like May. Maybe we could try for May.
Because
Um,
when you record, then when do you usually put it out?
I don't have like a substantial lead time. I'm like 2 weeks
Okay.
out right now.
Okay.
Yeah. When do you think it would need to drop by?
Um, hmm. And when up, well, mid-May, maybe.
Yeah. Release it by mid-May?
Yeah. I mean, what do you think? Or, I mean, it usually takes a while for people to like get their loans consolidated.
Yeah.
I mean, what we could do is I'll put, what I'll do is put together a little like discussion about it, like a little blog, and we could have Mandy send it out to everyone who came to this lecture.
Hmm.
Just a little
Yeah.
blog post of thinking through it.
Okay.
We could do that.
Yeah. Okay.
Yeah, I'll write something up and get it over to Mandy, and then we could get it out.
Okay. Do you have a blog on your website?
I do. I Not yet. This will be the first post. How about that?
All right. Well, then we can like promote it off of your link. That way
Okay.
people can see your website more. So,
Okay.
yeah.
No, that sounds good.
Okay. All
Mandy,
right.
I'll let you know when I get that together.
That sounds great. I do plan on sending out a follow-up email. And so if you want me to wait for that, I'm completely fine.
Yeah, when were you going to send that out?
Well, I was hoping to send it out Monday, but if it goes out the next Tuesday or Wednesday, I'm sure people won't mind. Um,
Okay.
I was going to request the slides and anything else you guys want to send for references, and then send that to everybody who registered.
Okay.
Mm,
And my dogs are barking in the background. I'm sorry, I'm going to mute out again.
that's all right.
I can't even hear your dogs barking.
Yeah, I can't either.
Say you're safe here. I didn't hear the dogs either.
Yeah.
Well, that's
Um,
good.
yeah, Larry, you wanna do a podcast with me?
Sure, love to do that.
Okay. Okay. Yeah, maybe we could do something that would get released like in July, kind of like for trainees as they're finishing up training and making sure they're clawing back any GSI opportunities before the 90 days or 60 days are up.
Yep, that's perfect. And I'll send Mandy some of my blog posts on GSI, so she'll have that too.
Perfect.
Okay.
Thank you.
Okay.
Awesome. I'm hopping on my next Zoom meeting. Have a great weekend, everybody. Thank
You
you that are
too.
still here.
Yeah.
Thanks for
You too,
participating,
Larry.
and we will chat again. You got it. Thank you.
All
Sounds
right.
good.
Thanks.
All right, I'm gonna duck out too.
Perfect. But thanks again, Tyler.
Yeah. Yeah, thank you. It was fun.
It was fun.
Have a good weekend.
All right. You too. Thanks.